offers that Chris can offer you guys and your clients. Both of these products are renovation products. They're one-time close products so that your buyers can buy and renovate a home simultaneously, okay? So I know a lot of you guys that are buyer agents and you take people around, they walk into houses and they say, I love this place, but I wish it had a pool, and it doesn't. Or I love this place, but it needs a new kitchen, or whatever. They can buy the home and do the renovations that they want all in one single transaction, protect themselves on the interest, etc. So there's two products. The first one is a conforming product, which conforming means 484 or less, 484,000 or less is considered a conforming loan. Fannie Mae buys these loans from us, and it's called the Fannie Mae Homestyle Loan, okay? The Fannie Mae Homestyle Loan. The first item I have up on the screen gives you the credit score. Go all the way down to 620 on this loan. Fannie has an automated underwriting engine called Desktop Underwriter, and if the loan gets approved in Desktop Underwriter, it's approved, okay? So there's not set debt to income ratios, and it goes as low as 620 on the FICO. For a first-time home buyer, we will lend 97% of the future value of the home after the renovations are done. When this property gets appraised, the appraiser is going to get the buy-sell agreement, and they're going to get the contract from the contractor showing all the renovations that they're going to do, and the appraisal is going to be subject to the completion of those renovations and a future value after it is all done, okay? So when they apply for the loan, they get the 97% applies to the appraisal or the lesser of the appraisal, or the addition of the renovations in the purchase price. So for example, if you're buying a $400,000 house, you're putting $100,000 worth of renovations in it, you've got a $500,000 package. If it appraises for 500, that's what we're going to do the 97 on. If it appraises for 480 with the improvements, then we'll lend 97 of the 480. Just like on a normal purchase transaction, if the appraisal doesn't make it. We haven't had too much trouble with the appraisals, and usually you're bettering the home a lot because you're in an older home, or you're in a place where they need things done. So well, we're going to get there. So what I would, thank you for that. This is right on the screen right now is primary residences. We do 1 unit to 97 for first-time home buyer. If they're not a first-time home buyer, it's 95% instead of 97. We'll do 2 units at 85%, 3 or 4 units at 75%, and that is for owner-occupied only. Second homes, we will do only single units or warrantable condos at 90%, 10% down on a second home, okay? And for investment properties, if they're not going to live there, we will only do single units, and we do 85% loan to value on a purchase, and a refi, which you probably wouldn't be involved in, is 75%. And I think the assumption there is from Fannie Mae is that the purchase price helps give a better indication of market. So if it's a purchase, they're willing to go up to 85 rather than on a refi 75. Okay.
Show the second home slide again.
You bet.
The question is it a combined loan, or it's a combined loan, not a second loan?
No, so it's one loan. So let's just take the example I gave you. So a $400,000 house, you're putting in $100,000 worth of renovations, a $500,000 package. Let's say they're not a first-time home buyer, because the math is easier for me. It's 95% loan to value, so it's a $475,000 loan, and we will pay the $400,000 house off at close. We'll take their 25 down, and we'll take 375 from the mortgage. We'll pay off the house at 400, and then we put the 100 grand in escrow and let the builder draw off the escrow money to do the improvements.
Okay, fantastic. Just moving on, and for everyone online, we're going to try to hold our questions to the end, because I bet you will answer most of the questions here going through.
Yeah.
So we don't want a 2.5-hour presentation.
That's okay. Yeah, we're good. So on the second home, it would be 450. So it'd be 90% loan to value. On the home style renovation, we offer fixed rates, 15 and 30 year. We have a 3-1 arm, a 5-1 arm, 7-1 arm, 10-1 arm. We do conforming loan amounts, as I said, up to 484. We do all primary, residence, second homes, and investments. Soft costs can be financed. I'll get to that, what soft costs mean, a little bit further down in the presentation, but they can be financed. This loan is fully dispersed at closing. So the buyer is paying PITI from day one, okay, on the loan. And then the renovation money is in an escrow account that gets drawn off of by the builders. Now, if they're doing such a significant renovation that they can't occupy the property while the renovation's being done, Fannie Mae allows them to borrow, as part of the soft costs, 6 PITI payments in the loan and add it to the loan amount to pay for 6 monthly mortgage payments so that they don't have double housing the first 6 months of their renovation. So, okay. Full builder, third-party contracts only. This is always coming up. So the builder can't be their uncle, their dad, their brother, their employer, they can't be themselves. Even if they're a contractor, they can't do their own work themselves. It's third-party contracts only for builders. Okay. Now we have a third-party vendor called Granite Loan Management, and Granite Loan Management does the builder approval, the project approval, which I'll talk about in a second, and all the draw approvals for the contractors when they're drawing their money. The builder approval is basically a builder application. We do a soft credit pull on the builder. We get their license, their workman's comp insurance, liability insurance, all the things that you go to make sure they're in good standing and a licensed contractor. We're looking for builders that have been in business for at least 3 years and that they've been doing projects like the one you're asking us to approve them for. And here's what I mean by that. Lots of times I'll get somebody send in a builder that's done nothing but $40,000 or $50,000 renovations for the last 3 or 4 years, and now they're doing a $500,000 renovation. I'm not approving that builder. That builder doesn't have experience in a project of that scope. So they need to have experience in the scope that they're being asked to be approved for. The project approval, which all this goes through Chris. Chris takes the application, he deals with Granite, he gets the builder approved, he gets the project approved. The project approval is a feasibility study on the contract and the amount. So what Granite does is put the improvements into the system and the cost per square feet or whatever they're doing, and just making sure that the contractor didn't underbid the project or leave something out, okay, that he should have had in there, because you don't want to find that out after the loan closes and we're in the middle. If the guy underbid the project and now he's coming back to the client for more money, there is no more money, right? So now we do suggest on these home style loans that everybody do a 10% contingency. So when they sign their contractor up, let's say it's a $100,000 improvement, have them add $10,000 contingency money, make the contract $110,000. We'll see if it'll appraise. You can always back it out later. If it'll appraise, then they have $10,000 extra. And if they open up a wall and they find something really wrong with the house that they didn't know about, and now we've got a little extra money to fix surprises when we're working on the renovations. Okay. If in fact they don't use that money or a portion of that money, when the project is complete, the rest of the money goes on the principal balance of the loan and lowers the loan amount. Okay. Does that make sense? Eligible property types. We go, I don't know why it says 1 or 2 unit. We go 1, 2, 3, or 4 unit on primary, and we do single family on seconds and investment properties. We do PUDs, we do site condos, and we do regular condos if they're Fannie Mae warrantable, because Fannie Mae is the one buying these loans. Work must be completed within 12 months of closing, and the improvements must be common to the area. They allow you to do just about anything, and even including a accessory unit can be done as a renovation loan. So if somebody wanted to build, if they had room on their property and it was common to the area and we could get comps, they could put a mother-in-law unit in or something like that. It'd be considered an acceptable renovation. talked about the contingency, and we talked about the payment reserve already. All of you guys will get this presentation emailed to you later today after it's done. So, questions about the home style product before we jump into the next product? Yeah.
The appraisal is still done prior to renovation.
Yes.
The appraiser is assuming the value that they put on a new roof.
That's correct. That's correct. That's correct. Or even a room addition or whatever it is. Yes. That's absolutely right. Yes. So we do owner occupied, 2-family, 3-family, and 4-family, but not investment. Investment has to be one single unit only. Yes, sir.
Say the scope of work and everything, like you said, 100,000, that 400,000, then 100,000 for the work done, and then the appraisal comes in, all the work's done at 480.
Yep.
$20,000 difference.
Right.
Does the homeowner have to, where's that come from?
Well, the homeowner would have to come up with the 20 grand, or they don't have to buy the house. You should write the contract contingent on being able to get the financing and the home appraising. So no. So
that would throw off the whole 3% down.
It would, yeah. But like I say, we don't have too much trouble with it. I mean, they usually appraise. Yeah.
Doug, did you explain the 75%?
I did not. That's a great one, Chris. So the Fannie Mae limits the size of the renovation project to 75% of the future value of the home. So I'll give you two examples, one that works and one that doesn't. You're buying a $100,000 house and putting $400,000 of renovations into it to make a $500,000 house. Basically, you're knocking it down. But you know, in that case, they wouldn't allow that because the 400 against the 500 value is 80%, and that's over the 75% threshold. But if you were doing $300,000 of renovation on a $200,000 house for $500,000, that would work because the 300 is only 60% of the future value of the home. So,
75% of the future value.
yes, correct. Yeah, that's the limit. And here's why they limit it. It used to be 50, and then they upped it to 75, which opened up a lot more big renovations to be able to do on this product. But the reason they limited it is they don't want you to do a tear down and a rebuild. And you know, if you don't limit it, then you could tear the whole house down. They have other products. I have other products to do tear down, but it's not this product. It's not the home style renovation loan. So, okay. Yes. I'd have to ask an underwriter about that. I'm not an underwriter, but it's probably okay. But if you want to grab me afterwards, I'll get you a card and you can send me that question and I'll get you an answer. Okay, appreciate it. For people on the phone, she asked, what if somebody had great credit and the wife had no credit? Would that work? And I said I thought so, but I'd have to check with an underwriter to be sure.
And did you explain the difference between a renovation up to 80,000 and the other one that's above 80,000?
Yeah, so I talked about the builder approval process, and you're picking up everything, and it's so good you're here.
I'm fourth class.
Yeah, fourth class, yeah. So if the renovation's less than 80,000, we do still collect builder license and insurance and all that stuff, but we don't approve or not approve the builder, okay? So there's no builder approval for a renovation less than $80,000. We still have to collect some documents from them to make sure they're in good standing, but we don't run the credit report. We don't, look at the history or anything. We just, if they have a builder.
Basically, the buyer's the general contractor.
They're the general contractor, but the buyers, it's buyer beware. They better vet them themselves if it's less than 80,000, because we're not vetting them at all. So.
In the case where you are vetting them, as long as it's plumbing, it's done by a plumber, electrician, you don't have to hire a GC to then subcontract.
You do have to hire, the program requires a GC, okay? And we'll make some small exceptions if you were doing like a roof and a pool, okay? I'm not going to make you hire a GC who's going to pad the whole thing by 15%, because the roofer's not going to hire the pool guy and the pool guy's not going to hire the roofer guy. That one would make sense, and we would go ahead and approve the borrower as the contractor and let him or her pay the subs. But I'm not set up to do multi tasking as far as paying bills, and it also adds risk to us, the bank, to have the client be the GC. In other words, be managing all the work. So we require a GC under most circumstances, and they would have to hire the electrician and the plumber and the HVAC guy and all that stuff. That's correct. Sorry. I don't necessarily agree with the rule, but that's the rule. So, yes, sir.
So that means, for me, I've got a roof company.
Yeah.
So I can't partake in roof. If I bring a buyer, I got to outsource that to contractor.
Yeah, because you're not an arm's length transaction. So, yeah.
One of the things we actually do, very similar to right here, we do the project management, where you were saying typically homeowners need HVAC contract. Oh yeah, you're doing.
Oh yeah.
So what we do is actually contact. I've got all these contracts.
Yeah.
And we'll bring in, since the way forward is written, everybody's contract, and we'll bring in all the specialized contractors working directly with the homeowner in that case, and basically oversee all the general contractors. And the cool thing is actually the price points that we have passed on. So that seems, in a sense, what it means is you, the homeowner, can actually contract about 4 different general contractors.
Yeah. In that case, though, how does the money get dispersed? Because we require it to go through the GC. We can't do that. So. No, because we aren't set up for multiple contractors. We got 400 of these suckers going at the same time, and if they all had 4 or 5 subcontractors and we got to do W-9s on every subcontractor, it just becomes an absolute nightmare for us. So we insist that the money goes through one person. Yeah.
So you can be the contractor for everybody else in this room.
Yeah. Yeah. Any other questions about the home style? How about online about the home style? Questions? You want to type in a question?
And you discussed the 6 months worth of things
I did.
that they can plug into the deal.
I did.
All right, great.
Someone asked how long it takes to generally close on these.
That's a great question. So you should write your contracts for 60 days at least. If they knew if it was a small renovation and you could get a contractor right away, a bid right away, you could probably do it in 45. But typically, there's some moving parts here. You got to get the builder approved with Granite. You got to get the project approved with Granite. And, they got to find the contractor they're going to use, and et cetera. And sometimes days just go by. So I hate for, if you write it too short, then, the seller is complaining and looking, doesn't want to do an extension, et cetera. So I would suggest 60 days.
We had an insurance agent at yesterday's
Oh,
meeting.
that's a good one too.
So if it's one of these deals where it's going to be kind of a minor deal, it's just going to be normal insurance. But if it's going to be a major kind of a renovation, then they're going to have to get a special construction/building insurance policy, which I am told is a little bit more expensive.
Right. It's builder's risk insurance. They'll have to buy it for 1 year. They'll complain and say, but the renovation's only going to take 5 months. But you got to buy it for a year, and then when they convert the builder's risk to the homeowners, they'll give them the prorated amount back off of the builder's risk. Okay. And these loans, Fannie writes for 1 year for them to get the work done. You can usually get an extension if it's over 1 year. So if there's been a hurricane or something, or let's say, God forbid, but this happens. It's happened. They fire their contractor in the middle of the project and have to hire a new contractor, and now we're going, longer on the deal. Fannie will usually give a 6-month extension, so it should work. Yes. No. That's why the project gets approved by Granite, so that we know that the bid is reasonable for the area for the work being done. That's that feasibility piece that Granite does with the project. So no, you're not required to get multiple bids. What do you mean by that? If it's under 80,000, we're not doing that. But if it's over 80, we are. And but the client, the buyer, is the one picking out the contractor, not us. We don't give contractors, so we just approve them on a deal by deal basis to be able to use that contractor. But you know, they're going to have to find their own contractor.
So the safeguards on this deal basically are, the first thing's the appraisal, right? Because it's going to have to appraise. That's the first protection for the buyer. Then you discuss the draws.
Yeah. So draws. What would I do without you? I'd leave half the thing undone. But the contractor can get a 10% draw at closing, 10% of the contract, and then we advance for work in place. So it's not work ahead of time. It's not I need to put the HVAC system in, and so give me the $10,000 so I can go buy it and put it in. It's when it's in, we give the money. So for custom things like cabinets and things like that, we will allow a 50% deposit and let them draw 50% to order things that are custom. And also for smaller projects, we'll go over the 10% at close. If a guy's putting in a pool, a $50,000 pool, he's probably got a payment. He's probably going to want 10 down or 15 down or 20 down. And then the rest when the pool's done or whatever, we'll work with those kind of terms as well. Now, when the builder goes for the larger projects, when the builder goes in for a draw, they sign a paper, or the GC signs a paper saying, these are the things I'm drawing for, but so does the borrower sign the same piece of paper that they approve, because it's their money, that they approve the draw to be taken. And you need to advise your buyers, and we try to advise people that if they're having a trouble with their general contractor and they don't like the work that was done, don't wait till the end to say something, because the end is too late. Because I have people call me up and we're 80% done, and they say, none of the work is up to par. It's all garbage. And I'd say, well, you signed the last 3 draws. Well, I thought I had to sign, they said. No, if the work was garbage on the first draw, you should say something on the first draw. We should try to come to a meeting of the minds with the contractor early in the project, not later in the project. Yeah. Yeah, so so the builder and the client sign the draw request. It gets faxed into Granite. Within 4 hours, they will order a field inspection to see if the work is done that's being requested. But that inspector is only making sure the work is done. He or she is not judging about the quality of the work. So that's the one thing I want to point out, because people say to me, well, your inspector passed it. Well, no, that's not it. I'm not the local ordinance. I'm not the guy giving the permit or anything. I'm just making sure that if it's a furnace, the furnace is in, and they're not qualified to say whether or not the workmanship is correct or not. So, yes, sir.
So you said this is like a 60-day loan process. Is most of that in underwriting?
No, so by the time you find a contractor, get a contract, have the builder fill out the package, get it into Granite. It takes a week to week and a half for Granite to do that. Granite is our third-party vendor that does our builder approval, project approval, and draw approval. And the reason we use a third-party vendor is the lien laws are different in every state. We're doing business in 49 states. So it's tough if we were to do it inside our own company to keep up with what's going on state by state, and they do that for us. So. Okay, so the second product that I have is a one-time close 30-year fixed jumbo loan. Now, this particular loan was meant for ground-up jumbo construction. It's a one-time close, but we have allowed renovations to be done on the jumbo one-time close, and in fact, 40% of my jumbo one-time close business is renovation business. So somebody can tear down a house completely and rebuild a new house, or they can do any size renovation that they want. You could buy an $800,000 house, put $500,000 into it, do it simultaneously at the beginning. You know, we'll pay for the house at the loan closing, then you can draw off the 500,000 as you do the renovations. The difference in this particular product is it is not fully dispersed at close. It is interest only on the amount of money dispersed, okay? And then, you know, as you draw it up, the interest only goes up, and when the project is 100% complete, then we roll it into a 30-year fixed rate loan, okay? So for this product, we at a 760 credit score, these credit scores are a lot higher on the jumbo side. So 760 will go to 85% to $1 million, no mortgage insurance. For anything less than 760 down to 720, we require 20% down, or 80% at $1.5 million, and 70% to, in this market, it's $2.5 million as our maximum loan. Okay, so you can get into some big projects with this. We also do second homes on the jumbo one-time close, and this tells you what the loan to values are: 75% at $1 million, 70 million and a half, 65, 2 million, 50% at $2.5 million. Can do a purchase or refinance. It's the same exact granite process: builder approval, project approval, draw approvals. The home is purchased, or the current mortgage is paid at initial closing, and then the improvement amount is held back. It's interest only plus escrow during the construction period, and then the loan rolls to the permanent phase upon completion. We offer 3 different terms on the jumbo. It's 12, 18, and 24 months. For renovation loans, for the purposes of this discussion, I would assume everybody's going to choose the 12-month option. Even if they think they can do it in 6, they're going to have to take the 12-month option. If they get done early, their loan will roll early into their 30-year fixed rate loan. And so there's no penalty for getting done early, and we're not going to keep them on the interest-only period for the entire time. The way we price this product is we add 75 basis points to our normal 30-year jumbo rate, okay? So let's say our normal 30-year jumbo rate today, purchase money rate, was 4 3/4. The rate to get this loan would be 5 1/2, okay? They would pay interest only at 5 1/2 during the construction period, and then the loan would roll to 30 years. They will do no worse than the 5 1/2. However, we offer a float down at completion of the home to the then current jumbo rate plus 1/8. So in my example that I just gave you, if the rates were still 4 3/4 for regular purchase money loans when their house is complete, they'd end up with 4 7/8 for their rate for their 30 years. So it's rate cap. They're protected. If rates go to 7 while they're building, they can do no worse than the 5 1/2 in my example. But if rates stay the same or go down, they're going to get a better rate when their house is done. Okay? Yes? No, it's an automatic. It's offered as soon as we get a final inspection. We have to do a modification on every loan because sometimes the loan amount changes or the maturity date changes. So at that time, our construction admin picks up the phone, calls our lock desk, and asks for what the rate would be today at an 1/8 above market, and they get that rate. Okay. And the reason I'll get right to it. The reason we want to do that is we don't want to go through all this work and then have them refinance and pay us off. Okay. We need to bring them back close to market so that they don't refinance the loan. I mean, the purpose of us doing these loans is to keep them, not to have them paid off after the construction. We don't make enough during the construction to make it worth our while. This program is not offered to investors. The first one, yeah. There's no prepayment penalties. This product starts $1 above the 484. Yeah, 485 and up, basically. So here's an example of how one would work. Client wants to purchase a $700,000 house, put $400,000 of renovation into it. We'll assume, so the acquisition cost is $1.1 million. We'll assume for now that it appraised for $1.1 million as well, okay? And we'll also assume that the client had a 760 credit score, which means I could give a maximum financing of 85%. And 85% of $1.1 million is $935,000. At the closing of this home, We'll take his $165,000 down payment. We'll advance $535,000 out of the $935,000, and we'll buy the home for $700,000. Seller's out of it. Now he's paying interest only on the $535,000 at that moment, and then as he draws off of the $400,000, the additional $400,000 to do all the improvements, his interest only payment will go up. When he completes the project, he'll convert to a 30-year fixed rate loan. Does that make sense? Does that make sense? I am told that you are, you know, land deficient around here, and that there might be a pretty big opportunity for people that, you know, they find the great location, but the home is older, or they want to completely tear it down or make it the way they want it. So, and the way you have to do it before these loans is you'd have to buy it and then, you know, get a loan and then refinance it, or go get a home equity loan at a different interest rate or whatever. This way you can do it all in one transaction. Yes.
Under $1 million, can they do?
Yeah.
Rebuild, or it has
Yes.
to be just a renovation?
No.
I have a client that wants to build a $450,000 house, buy the land and build.
Yes.
This would not be.
No, but I have another
You
loan.
have a different loan.
Yes, yes, and it'll be available to Chris. We do a one-time Fannie Mae close 30-year loan. Okay, it works very similar. So, meaning what?
Okay. Yeah, it's not gonna get. I know that he basically told the other guys to take a hike at 633, but they're sitting there waiting for him, and that's why I said just give me something above 630.
Oh yeah.
Obviously I'll present it to him, but I just know that
now we're trying to sell.
Waiting to go back to it, but he really does not want to sell the other guys.
Somebody's off of mute.
So
all
right.
What?
All right. Okay, bye.
We sell these loans, and we want to sell as many as we can. And for that reason, we do requalify the client when the house is done. We order a new appraisal and everything. But if for some reason they don't qualify under the original terms, they keep the original terms, but we have to put it on our portfolio. We have to put it on our books, which is why you won't see a non-bank lender offer a product like this, because they don't have any place to put it if something happens during the process. But if we can sell 90% of these, then we're going to be happy. Yes.
During the first 60 days when they purchase the property, does the client have to get architectural and engineering plans prior to closing?
Yes.
And get it all approved?
Yes. 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 So if it's a lot more complicated, you know, then I said, you know, so I said on the home style, because they're not usually that complicated. They're not as large as this. You know, 60 days on one of these, it might be, you might need a little longer than 60 days. It just depends on what the client needs to do. So.
Has everybody signed in on the iPad so that you'll get a copy of the presentation? We'll bring it back to the back. What about everybody up front?
So there's a question online on the jumbo loan. Is there still an option to finance 6 months of IO payments? No, that is a feature only in the Fannie Mae home style loan. First of all, you wouldn't know what the IO payments were going to be, because you don't know every month what they would owe. You could estimate the first month because you knew what the closing was, but then as they draw it up, the money would be different, so you wouldn't be able to figure that out. Correct. So if somebody has a $2 million house, but they're only borrowing $400,000, then they're in a conforming loan. So it's not based on the value of the home, but the loan amount itself. Excuse me. Can I also build homes from scratch with the construction loan on the land that I own? Yes, you can. And that's originally what the product was for. I also have a one-time close Fannie product for conforming loans, and I have this one-time close product for jumbo loans. So you can, you know, if you have a client that wants to buy a lot, okay, you can find them a lot, and they can build and buy the lot with this construction loan, and we'll pay for the lot at closing of the construction loan. So again, you just got to make sure that the seller understands this is a process. They're not closing in 3 weeks. If the seller on the land needs to close really quick, you're going to need to find a local lender that'll lend you on the lot itself, and then we'll pay that loan off when we close the construction loan, if that's the case, that the seller would not wait. So. Oh, was it? Okay. Yeah. Yeah, exactly. Yeah. Yeah, exactly. If they are entitled to the land when they come in to one of these loans for ground up construction, we're going to simply use the appraisal as the sole determinant of loan to value, which is really positive, because then there's no seasoning. They can own the land for 1 day. So if it appraises for more, then they can roll costs in and all kinds of things. So what we won't do is give them cash back, though. If they've paid cash for the lot, they can't get any of that money back, okay, once they own it free and clear. That's considered cash out, and then I can't sell the loan. What else, guys? Who in here thinks that they could use either of these products to help sell houses?
How many of you guys have had listings where you walk in and you go, oh my God, this thing's a piece of crap.
Yeah.
It needs remodeled.
Yeah.
And you get the listing and you're like, man, we're gonna have a tough time selling this, right? This is something where once you know you have a rough listing, you could go out and get some estimates for whatever you think it's gonna take to make the guy coming in buying it, that property more attractive. And then you can, all right, so the pool's gonna be 40,000, the roof's gonna be 25. To redo the kitchen, it's gonna be 30. I've got these 3 people willing to do this work, and I've got a lender that will do it. So that's a way to do it.
You run an.
You've got the client who nitpicks every single, you're taking them around to 30 houses, and they just nitpick every single house to death. So you can let them know ahead of time, hey, that house that we saw yesterday, the one that was kind of beat up, the kitchen was tore up, but you like the neighborhood, you like the yard, you like everything about it except that one thing. This is the loan that will stop that person from dragging you around for 5 months. Okay, you can get them in if you can hit most of their points that they want on a piece of property, but there's always one thing. You got that one client that there's always something wrong with the house. It's not perfect. This is the loan for that client that is really hard to please. And they can go in and renovate whatever it is, that one thing that they always seem to pick on every single house.
So there's a couple questions up on the board. If I have a hard money loan on a property, is it possible to do a cash out refi and swing it to a 30-year fix? I can't do a cash out, but I can do a refi. So if they wanted to do improvements and they had a hard money on loan, we could pay off the loan and do the improvements as a refi on this product, but not cash out. Go ahead. Yeah, and so people ask me that all the time, and I say I let the price speak for themselves. When you get $15,000 worth of closing costs, and you're paying 75 basis points over market rate on a particular loan, and the renovation's $10,000 or $15,000. I think there's a better way to skin the cat for those people. So on this jumbo one, it should be a significant renovation. I'd say 50 grand or more. I can do it for any amount. It's just not a good deal for the client if it gets too low. Let's see. There was another question. Let's see. Nope, that was it. Just a comment. Yep. Anything else, guys? Yes. I do not.
When they're done with the construction phase and they get ready to convert it into a normal 30-year fixed rate deal, because on this product, excuse me if I'm wrong, correct me if I'm wrong, but It's a 12-month interest-only payment during the construction. At the end of the construction phase, it converts into a 30-year deal. So in reality, they'll be paying on it for 31 years from start to finish.
Right, that's correct.
There is only, when they get ready to redo it, it's nice they have to come back in and re-sign 150 pieces of paper again. Doug mentioned that it's only a 2-page modification agreement that gets mailed to them. They get it notarized and they're done.
Yeah.
It's a no hassle kind of a deal.
Right.
And you guys are basically out of the loop after closing, so none of this comes back on you. We just want you to be aware of what's going to be occurring after the fact, so that if your clients have questions, you'll be able to intelligently answer. Okay?
Was there a question in the back?
There's no pre-penalty on any of these, whether it be a single family or.
There's no prepayment penalty on the loan. No, that is correct. Now, if the loan pays off in the first 6 months, it costs Chris something because.
We're going to drag out your
Yeah.
We won't take any deals where the construction's going to be 4 months.
Yeah. But that's why on the jumbo one, that's why we offer the float down so that people don't want to refinance. And on the jumbo one, we're coming out with a 5171 arm in the next 60 days. So that'll be lower interest rates than the 30-year fixed, than the exam. No 10-1.
Because the 10-1 rate's the same as a 30-year.
Yeah, company just didn't want to do the 10-1. So.
Let's say we buy the house now, and after we value it, $1 million.
Mm-hmm.
That's definitely now, a year later,
Mm-hmm. If it causes me not to be able to sell the loan, then I put it on my books. There's nothing I can do about it, and the client, there's no penalty to the client. There's no change in the interest rate or anything like that. We'd still offer them the float down. Yeah. Yeah. That's not what it's intended for, no. I can't police what people do, but it's not what it's intended for. So. Yeah, exactly. Look, if they, I had this question at the last session. What if they change their mind and don't want it, and then they put up a for sale sign? I said, look, if your intent is not to move into the home, and I'm lending you 95% because it's primary, that you should just, you know what I'm saying. Your intent needs to be that you're moving into the home, and you need to move into the home. So. That can be all included. Yes, it can. It can be all included. Pardon? Yes, absolutely. Appliances. The jumbo one-time close does not apply to condos. And the reason being is, and I may be able to get that changed in the future. The reason being is when we put the product out, we put it out as a ground up construction. You can't get a ground up construction in a condo project. They're all attached, right? And the project is being built by somebody else. So it says no condos. But the reality is we could do a renovation in a condo on a jumbo. So I'm going to have to go back to credit risk and get that added. But for now, for this moment, it is not. So. Yeah. Yeah.
No problem.
People do that all the time. Yeah. I mean, look. Yeah, I mean, it's just if your intention, look, we have investment property, right? So but just put the 20 or the 15% down on the home style if you're doing call it an investment property, and then you can do whatever you want with it. So. But no, not even FHA. Neither one of these are FHAs. This is a Fannie Mae is a conventional loan. The home style is a conventional loan. 203K is an FHA product that we don't offer at this point. So, and this product, it beats. I like this. This is a better product than that. So. Well, so if you go back to It's only single family, but I offer 85% loan to value on investment property. That's not bad. Yeah. Oh, but that's not conforming, not a jump. Makes sense? Well, oh, we lost our. Oh, jeez. I guess I'm hard on things. Hello, testing 1, 2. You know, I would talk to your broker about how to structure the offer. It should be contingent on them getting the financing that they want, which means if for some reason their contractor gets declined and we won't use their contractor, or if for some reason their appraisal comes in low and they don't have the extra money, they should be able to get out of the contract. So. Well, again, I would ask your broker. I'm not a legal guy. Purchase and see. Yeah.
You'd have to ask Jonathan.
Yeah, but you want to. Well, right.
I know that on the normal contract, there's a spot for VA, FHA, and conventional. I don't know that there's a spot on there for construction, is there, or renovation? But I would ask him just to be clear.
I'd check conventional and I'd say subject to getting renovation loan approved or something like that. That's what I would put it. Yeah. Go.
Are these subject to the same kind of loan rates that normally happen, or are the rates a little higher?
It's just a scooch higher on the home style, about a quarter higher. A scooch.
Grandma was cooking the
Just a pinch, you know. A scooch of pepper, a pinch of salt, you know. Yeah, just a tad, just a little bit higher, but not a lot higher.
What makes it different from a regular refinance in renovating?
It's not, well, the difference is I'm not giving them cash out. I'm allowing them to do renovations. So I'm going to do a future appraisal as well and lend them more money than they owe on the house to cover the renovations. So if you have clients that you've sold homes to that you know they need a loan like this to fix up their house, send them to Chris and we can refinance them, and rates are still low and they can get some stuff done. So.
Yeah, so if you sold somebody a house in the last 2 years and they told you, yeah, I'm going to buy this house, but I want to put a pool in, or 2 years down the road, it looks like we're going to need a roof, or whatever the case may be, bring those people into us. We'll get the deal going, and like you said, it'll be based on the future value instead of doing a normal cash out refinance, which is just based on the way it sits as is. Well, with this renovation loan, it's what is the house going to be worth after, and then we're going to use that value, but we'll give the person more money to do the renovation.
So we have some questions online. Can you give us a range of rates? I don't have a rate sheet in front of me, but it's like I said, it's about a quarter more than it would be for purchase money, regular purchase money loan. We will email you the online presentation, but you will not get my contact info because Chris is your contact. And so if Chris has questions about the program, Chris will come to me, but you go to Chris with the loans.
Online, if they can email me, and then I'll make sure they get it.
Okay. All right. Yeah. Okay. Everybody online, email Chris. And then you had a question about non-conventional building, like prefab, concrete, modular homes, 3D printing. I don't know what 3D printing is, but yes, we do modular homes, and yes, we can do almost any type of construction if we can get a good appraisal. People ask me, do you do container homes? Have you heard of container homes? So here's the question: can I find 2 or 3 comps that have resold that are container homes, and is the appraiser comfortable saying that what the marketability is of that? I mean, that's what the bottom line is. It's not about what type of construction it is. Can I get a secondary market saleable appraisal? That's the issue. So, yes. Well, this is what I would do, and I'm not a realtor, so I'm here as a lender. But what I would do is, so if you were showing me houses, you'd want to know what price range I'm in, right? So let's say I'm in a $500,000 price range. Then you could also show me houses that are in the $400,000 price range that need 100. They can do all the upgrades on and get to the $500,000 price range. You know what I'm saying?
Or the other side of the flip point of that would be, when you get with a couple and they say, these are my wants and these are my haves, or this is what I gotta have in the house. So if they say, I gotta have a pool and I gotta have a 2-car garage and I gotta have up-to-date kitchen with new appliances, and you're showing them houses that don't have those things, you can easily say, well, I know this house doesn't have those things, but it's in the neighborhood you want, it's in the school district you want. And if we put these things in, this house that's $375 is going to be worth $5 when it's all said and done, and we can make that happen.
Right.
On what it would be, what the house is selling.
Does the RPR report give you that option to put in? That's what I would use.
Yes.
Would the person then qualify for that loan after you have brought it up? Would they still qualify?
I'm not sure I understand your question. So in my example of the 5% down, $400,000 house with $100,000 worth of renovations, I'll lend them 95%. So it's a $475,000 loan. That's the loan they're applying for. Is $475. No, they're applying for the maximum. I mean, yeah, right. You have to qualify. Yeah, right. Exactly. Yeah, right. Yeah.
Exactly. So basically, to kind of recap everything, we've got 2 loans here. We've got one that's below $484,000, right? We've got another one that's above $484,000. So one's a normal one, and the other one's considered a jumbo. The one that's the higher amount, a little bit tougher restrictions, a little bit lower loan to value on that, right? And then we've got the normal conventional loan that they'll go up to $484,000, where if it's a first-time home buyer, we're going to go up to 97% of whatever the future value is. So if they're buying a $200,000 piece of property, and then the appraisal comes back and says, yeah, after they do this, this, and this, it's going to be worth $480,000. We're going to loan them $480,000, and we're going to go to 97% of that. And if
can I just correct you a second? Unless it's a lot higher than the acquisition, we're not giving them money in their pocket. So,
right.
Yeah.
Right.
Right.
And then you guys are all familiar with the $2,000 MCC credit that we have for first-time home buyers. That will help out a little bit when they get their tax refund check back following year. And that will help them qualify for the loan program, because the underwriters allow us to add that $2,000 back onto the application as income to help get the guy qualified, right? So has everybody got it kind of covered on the 2 different pieces? Naturally, the one that's the higher one is a little bit more restrictive. The lesser one is going to be less restrictions. Very easy to qualify for. You only have to have a 620 credit score, right, Doug?
That is the minimum credit score.
Minimum credit score.
No, jumbo was 720. Yeah, correct.
The best deal you had at 760.
Yeah, it's all in the presentation. Yep. Any more questions online? People that are out there, can you still hear me? Yeah, you can call Chris on the rates. Rhonda, he'll help you out with that. I don't have a rate sheet in front of me, but it's about a quarter over normal purchase money rates. Okay. Thanks.
Okay. Yes. Last question.
Fannie Mae does look into appraisers, realtors, everything, and if they feel like you're misusing the program, they'll put you on a list that says that you can't get your client can't get a loan from them. You know, so in other words, if we're doing 97% loans to people that are selling houses a year from now all the time, that's a problem because that's not what normally happens. So.
Anything else? Any other questions? If you have any other questions, call me anytime, email me. If I don't know the answer, I'll get with Doug and Rob. We're going to probably hang around here for another 5, 10, 15 minutes, and then we're going to do a little happy hour down here at the Foundry for anybody that attended the class today. So anybody that would like an adult beverage. I know nobody in this room really likes to participate in adult beverages.
He must know you really well, huh?
Somebody take the bull by the horns and get her out.
Thank you to everybody online for coming, and thank you all for listening to me today. So, yep.
Thank you, Becky. Woo!